All right, good afternoon, everyone, and welcome to our Liquid Alt Q4 2022 update and outlook. My name is Robin Finlay. I'm based in Calgary, and I'll be your host for today's call. A couple of housekeeping items. You're probably all familiar with this after 2 years of Zoom calls, but there is a Q&A box at the bottom. Please feel free to fire away with questions throughout the call. And at the end, we will have a period of time for questions for both of our speakers today, Jim McGovern and Chung Kim. So I would encourage you to do that. Secondly, and I'm quite excited to announce this, we've added a new team member in British Columbia as of this week. His name is Tim Shrigley. For those of you in BC, I'm sure that's a name that you're familiar with. So please take a moment to reach out to Tim and welcome him. And we're really glad to have him. He's a very typical Arrow Capital sales and marketing executive, lots of experience, lots of time around advisors, understands the business very well, and certainly look forward to having him working with us out on the West Coast. So welcome, Tim. All right, if I can get you to move ahead here, Colin, we'll get started. Past the disclaimer, there we go. Quick review. I think most of you as well have seen this before. One thing I do want to make mention of, the global expertise in liquid alts and active portfolio management. That is something we're very proud of and that we've been doing for basically our entire tenure as a firm. So in this category of liquid alternatives, where there is an added element to skill set and expertise to work with more flexible investment vehicles, that is something that we have built a powerful reputation on being successful at executing. And it's something that I think sets us apart from many of the other alternative providers, certainly from the long-only mutual fund complexes. Next slide, please. Just a little bit about our presenters today. Jim McGovern, I'm sure you all know, founder of Arrow. It's been under his leadership that we've gone down this path of alternative and active management. He's long been a proponent of active management as the way to get you to the dance, so to speak. And it's been under his tutelage that we've built this nice little complex that has had tremendous success in delivering on independent and actively managed mandates. And Chung Kim is a more recent addition to our team in April of 2020. But he brings a really interesting skill set after 15 years on the institutional equity side. Worked with basically all of the alt managers in Canada, and from that was able to glean the good and the bad from running portfolios. And I can tell you he's quite proficient in his stock picking capabilities, and he's an alpha generator for sure. So that's been a great addition as well on the fundamental side of the portfolios. Next slide, please. There's just a quick overview of the funds that we're going to talk about today. And I should mention, these are the funds that are managed internally at Arrow. There is a fourth alt fund that is not on here that won't be part of the conversation today, and that is titled the Arrow EC Income Advantage Alt Fund. It's managed by our longtime partner manager, East Coast Fund Management, and focuses on Canadian investment grade credit spreads. If there's information that you require on that, we're happy to share it with you. Just reach out to your local representative. But for today, we want to look at the macro and the equity mandates. And so from here, I would like to ask Jim to take us through the next few slides and talk about the Global Advantage Fund. And then following Jim will be Chung to talk about Canadian Advantage and global opportunities. So with that, Jim, I'll hand it over to you.
Great, thanks, Robin. Actually, could you just flip back one slide, Colin? And yeah, good afternoon or good morning to all our friends, and thank you for tuning in. It's obviously a pretty busy day here, both at our shop and I'm sure where you are, given some of the economic news that has certainly surprised a lot of folks. So just want to quickly touch on, so the way these funds are organized, you can see, I'm going to talk about Global Advantage, and then Chung's going to talk about Canadian Advantage and global opportunities. And there's sort of a spectrum of risk reward across these three accounts and also different focuses. So I'm taking a multi-asset, low vol, low correlation type fund, and we'll stretch that right out to a pure equity type long short, more a more kind of aggressive account, if you will. But what's interesting about all these accounts, and what we say low drawdowns or moderate drawdowns, but we're actually we actually really mean that. And when you comp our numbers against the peer group, you'll find that that's the one thing that really stands out is the ability to protect capital. And I think that's going to be more and more required in a world that is becoming either kind of binary to the extreme or full of what you might call unknown unknowns. Next slide, Colin. Just to give you an idea on that, it's no surprise a lot of folks have been, let's say, hiding in traditional 60-40 type portfolios. Those have been really exposed given what's happened in the bond market this year. And but it's not just this year. This is not, it's not super common to have a year like this, obviously, but it is something that for us at least signals that you should be including alts in a traditional portfolio. So it shouldn't just be 60-40, it should be 50-30-20 or 10% alts or whatever your organization or you think is appropriate given the customer base that you have. But I would just argue that demographically, we see more older investors. We see more people very sensitive to draws, especially when they're on withdrawal programs like RIFs and so on. So I just think what we do is just naturally a nice thing to add, and we think we do it pretty well. Okay, next slide. So I'm going to get into our fund, and everybody's probably familiar if you listen to Ted Whitehead, who runs our growth and income fund, or if you listened to me in the past, we have, from a macro standpoint, this cyclical model that we look at that was really an offshoot of the work done by Ray Dalio and really pioneered and promoted and improved by the folks at Hedgeye and other, especially them and other organizations as well that have added tweaks to this. But for us, there's two key things that we're trying to forecast on a reasonably short-term time frame, like 2-3 quarters out, and those are headline inflation and real GDP. And when you have two variables, you've got 4 different combinations of those variables. And right now we're in a market that is characterized by falling real GDP and also falling headline inflation. And that might sound like a bit of an oxymoron given what you heard today, but we actually haven't taken out the high in headline CPI. We printed 8.2 this morning, but our forecast is for that to fall. The trick with this cycle, because every cycle is different, and this model is showing you kind of a static view of how we be positioned, but the devil's always in the details, right? And right now, with inflation over 5, this makes it requires some modification, particularly on the debt side with bonds that we have to take account of. But we'll get into that in a minute. So next slide, please. So here's our real GDP forecast. You can see they've been steadily coming down since the peak of Q2 21. A small bounce, sort of technical bounce, but really pretty much straight down. You can see that we're looking for pretty much either side of zero over the next 6 months in terms of real GDP. So are we or are we not going into recession? Really doesn't matter. There's just not going to be a lot of growth there. So when there's no GDP growth, it makes it a real challenge for profits, obviously, and hence our typically pretty low weighting in equities at this time. Next one. But the real issue on everybody's mind, I would argue GDP is going to be the issue, or lack thereof is going to be the issue in the not too distant future. But for now, it's definitely inflation. Everybody's completely focused on this. You can see we printed the peak in the second quarter in our view. It's going to be a steady fall down, but the fall is, from a headline perspective, is going to be sticky. So we're in the camp that says sticky for longer. And you'll notice that we don't break that 5% level. And you can see we're above consensus as well. Those are the blue bars versus the yellow. We don't break that until the second quarter, towards the end of the second quarter next year. So that obviously has ramifications for bond investing in particular. Next slide. So this is the headline CPI broken down. You can see the top line there, 820 is the year-over-year release this morning, and the 663, which is the core CPI, which is at 6.63, and it's continued to go up while headline has gone down. And you can see it through the blue bars there. That's services, and services has really been the challenge because it's the largest component of CPI. It's obviously not as variable as the goods side necessarily, but it is very much a function of wages and the fact that it's the biggest part of the economy. It employs the most people, and what you're seeing going on in wages is sort of almost a direct reflection of what you're seeing there. And that is, in fact, what the Fed is really truly focused on right now. Next slide. One of the big components of that services is rents, and the biggest part of that is something called owner equivalent rent, or OER, which they derive from house prices and impute back in our rent. The challenge with this calculation, I mean, and everybody knows it operates with a substantial lag. So it's steadily gone up. It went up again today, and we forecast it to continue going up through the balance of the year and into the new year. So that'll make the data look really bad. I think most market professionals will know that this is something that is a lag, but nonetheless, it is something that is continuing to push rents higher. What we have going on now, though, is obviously with the higher rates and so on, we've seen the peak in house prices, and they're starting to roll over and come down now. So we expect that to kind of meet up and stop being inflationary towards the end of the first quarter next year. Next slide. The other component that the Fed looks at, but more importantly, the politicians look at is gasoline prices, energy prices. And you can see for the last 3 months, this is a month-over-month chart as opposed to year-over-year, you can see that those have been down. The risk here, obviously, is with what's going on with the OPEC cuts and also the potential curtailing of draws from the SPR in the US. These are two things that might, in fact, help move oil prices back up. We're seeing prices move higher today. That gets through to the pumps, and that's generally not good for headline CPI, and certainly not good for the politicians or the consumers. Next, please. So I was talking about before, the wage situation is really what's somewhat problematic, and the longer headline inflation stays high, the greater the propensity is for wages to remain, to continue to grow and to remain sticky and high. And that's a function of whether it be COLA clauses or the increased negotiation power of labor in general, given what's happened with labor supply. But in this chart, you can kind of see that the black line is the overall Atlanta Fed wage tracker, and then you can see the blue line is this job switcher data, which we kind of find interesting. So because you have this labor shortage, you're getting people leaving a job with Bank A, for example, moving to Bank B. Bank B is giving them the rate, a big hike that's even more substantial than what the typical wage growth has been. And that, in fact, is kind of helping keep and inflect the wage levels higher. We have seen the BLS data, the average hourly earnings kind of tick down here a little bit, which is good, but you can see that there's still a pretty big spread there, and we expect wages to continue to be an issue. Next slide. When the Fed's raising rates, short-term rates, it's obviously trying to impact the market, and one of the things they look at is financial conditions. They're trying to see the impact of what these hikes are doing. This here just looks at the Goldman Sachs Financial Conditions Index, and on the top panel, the bottom panel is the year-over-year change. You can see starting almost not coincidentally with the rate hikes in 21, things started to get a little tighter, and here we are now, well above 100, which is the level we get in a tightening condition. The challenge, though, is we don't think we're there yet. We think conditions have to tighten considerably more for the impact. For the Fed to have the necessary impact to slow the economy, in particular, slow inflation. Next chart. One of the problems the Fed is going to have with this is that the consumer at least in the United States, is in really great shape. These 4 panels kind of highlight the fact that the consumer has lots of cash still kicking around, either through elevated savings through the pandemic and also pandemic bonuses and surpluses given out by the government. And the bottom panels show how good the debt is to relative to the household balance sheet, and disposable income. So we've got a consumer that's in a really terrific shape. So it's hard to get them to necessarily stop spending or curtail activity at this stage. Next. Ditto corporations. Yes, we've seen the rise in the prices of debt, corporate debt, high yield debt, and so forth. But this chart here just shows that nominal GDP is one of the things you need to be looking at, because nominal GDP is what feeds into top line corporate revenues. And when you put that against the wage bill, in this case, we're looking at the employment cost index, which also includes productivity. You can see there's a pretty big spread there, about 4.5%. So that has been narrowing, and that's why you're seeing the rate of change of corporate profits fall from a peak. You could also say the rate of change of, in terms of margin expansion is also falling as well. But we're not in negative sort of territory here. And this is where, again, the Fed is looking at this and saying, we've got to get that nominal GDP down, we've got to get demand slowing. But for now, we don't expect corporate profits to fall off a cliff. I mean, they're sequentially, they'll start to inflect down, but from a quite a very high level. Next slide. One of the other models we look at, this is a fairly simple one. It's from Piper Sandler. It's the old Cornerstone macro guys that we've been doing business with for a long time. It's their HOPE model. So housing, new orders, profits, and employment. And here we can see there's a sequencing down. Housing we know is already rolled over, and we'll see how this is kind of moving forward as you kind of expect it to. So
Hey, Jim, I think you might have been muted. Yeah.
All right, maybe Jim, you work away on your technical stuff there. And while we get that sorted, Colin, let's just slide ahead to where Chung will start in on Canadian Advantage. And hopefully we can get finished up with Jim when we get our technical stuff sorted out there. So from here, Chung Kim, let's talk about Canadian Advantage and global opportunities.
Great. Thanks, Robin. Thanks all for joining. And so we'll move to slide, start to the next slide there, Colin. So as Robin said in the beginning, I joined Arrow mid-2020. Before that, I was an institutional salesperson for about 15 years in Canada, covering mostly Canadian hedge funds. And kind of my role here, for those who I haven't spoken with, I'm managing or co-managing a couple of different mandates. Specifically for this forum, I'm co-managing Arrow Canadian Advantage, and I'm the sole manager of Arrow Global Opportunities. And so, as Jim and Robin alluded to earlier, Canadian Advantage is a bit of a blend of the top-down macro process that kind of Jim manages in Global Advantage, and more of a bottom-up long-short equity process that that I run with. And we kind of blend the two disciplines together in Canadian Advantage. And that expression, that investment expression is wholly expressed in Global Ops. Next slide, please. So the one thing I would say first is, in a regular market, how I generally think about the market is stock picking, bottom up, long short equity stock picking. And for much of 2020 and 2021, that's how I manage the mandates. Generally speaking, I'll be opportunistic in terms of where I think the opportunities are, where I think the risk is. And the good thing from my perspective is there's quite a bit of flexibility of changing exposures and looking at different parts of the market depending on the opportunity set. Now, for most of this year, given what's been happening with the macro, I've pivoted quite a bit, and I'm spending most of my time in top-down macro. And I think, as all of you probably can attest, it's become a very macro-driven market where correlations have become almost kind of to one or -1. And fundamental stock picking, in my view, has actually become less important in a market like this. So that's where I'm spending most of my focus, and that shapes my fundamental views. So this is a summary of my views. They've pivoted or changed throughout the year. At this point, we believe that a recession is inevitable. Whether we're in one now or it's coming, we'll only know kind of after the fact. But with that base case view, how we think about the portfolio and our exposures, that's obviously shaped by that. Taking a step back from a longer term perspective, my view of the market has been that there's been these pretty big macro tailwinds, arguably for 40 years, and definitely for the last 10 to 15, that has really driven liquidity and to a certain extent, overvaluation in a lot of the market, creating bubbles or mini bubbles that I think is in the process of unwinding. And I think a lot of those tailwinds that we've had for the last little while, I think they're reversing as we speak. Looking forward, even though we've had a decent drawdown, I don't think it's done yet. And the next shoe to fall, in my view, is true fundamental earnings deterioration coupled with economic deterioration. And based on that, I think it's too early to be taking risks. So next slide, please. So this was a slide that we put in the last update. Same thing applies from my perspective, and it's kind of goes through what I believe have been some pretty big narratives or themes that have driven the market for, again, in the last couple of decades. And a confluence of events have created a perfect storm to not even just halt, but potentially completely reverse a lot of these big themes and narratives. And with that, I think the market is slowly adjusting to the idea that that the market is shifting. And I think with that, certain things are highly risky, and there are certain things that have a lot of opportunity. Next slide, please. So kind of the view of a recession, I keep it reasonably simple. I use history as a guide to try to see kind of what's happened in prior regimes. Obviously not identical, but they rhyme. So this is just a chart from the Fed looking back at historical cycles when CPI was greater than 5. And you could argue about the sample size. I think the sample size might be 5 or 6 or 7, but every time that CPI was greater than 5, a recession followed. So in my view, the idea of soft landing, I think, and today's print is a reflection of that, or it kind of reinforces that, is becoming less and less probabilistic. And ultimately, we're kind of entering the time where the economic deterioration starts to happen in terms of a recession. The main question, if you believe that, obviously is how long and how deep and when does it start? I think the jury's still out on that, but given how high the print is, given how high inflation is, and how sticky it is for longer, we're open-minded to the idea that this could be a pretty bad one. Next slide, please. So with the talk about inflation, obviously you have to talk about the Fed. And here's kind of a summary of our views about the Fed. And for us, it's actually quite simple. We believe what they're saying. We think they've been quite clear in their intentions and what their reaction function is relative to ongoing data. And I think there's an adjustment to be made by the market again, because this is so the opposite of what the market has been used to for many years in terms of not fighting the Fed, them providing kind of endless liquidity. I think the big X factor as to why that's different is because of inflation. And there hasn't been a point, at least with this Fed, at its helm, that inflation has been the issue. And so I think their reaction function very rightfully is different. And so, so they've said that inflation is their sole focus right now. I think Powell has been very clear that he studied the 70s and thinks of Volcker as a hero and does not want to relive the kind of some of the mistakes that were made prior to him throughout the 70s in terms of starting and stopping. I think some of his comments reflect that, where he basically says we need to really see a pattern of inflation breaking before they really pivot. I think they won't say it blatantly, but I think they are willing to put the economy into a recession because I think they believe it's the lesser of two evils relative to not being able to create price stability. And I also think with that, they're okay if the stock markets or asset prices go down. If you kind of look at it pre-COVID, I think there's still been a positive return if you invested in the US. So arguably, even though this year has been painful, there hasn't been that much of an unwind relative to kind of recent asset inflation. And Neil Kashkari, there's a quote there at the bottom, has basically said that, where he almost has said that he wants the stock market to go down because that's a reflection or leading indicator of kind of tightening or loosening. And I think kind of with all of that, the biggest risk is that they overshoot, because ultimately the Fed is always behind the curve and they're always working off lagging data. I actually think they know that, but it is what it is in terms of how the system works. And the final conclusion within all of that is that this idea of a pivot, I think, is highly premature and minimum is quarters away. The caveat to that is if something breaks, and obviously all the stuff that's happening in the UK is a reminder. But if something does break, a la kind of late 2018, I think the markets will be down quite a bit before the Fed reacts to it. Next slide, please. So from a fundamental earnings standpoint, this is from Cornerstone Macro or Piper now, and this is just sample set of what earnings do in a recession, and kind of peak to trough, it's about 24-25%. If you look at where earnings are now, this is for kind of forward 2023, they're actually starting to come down a little bit the last month or two. I think they're down 6% from the peak. But I guess our argument is it's just the beginning. And ultimately, If you were to put a 24-25% drawdown from a peak of $250 in S&P earnings, kind of gets you to under 200 or 190. And so we're at about 240 now. Again, that implies that there's still more downside. Next slide, please. And so with that, if you kind of assume that scenario, the multiple generally does contract during recessions. I think before the market drawdown recently, I think we were trading at maybe 17, 18, 19 times. I think we're probably at 15 now relative to the 240 earnings. But again, if you assume earnings fall, I think the case definitely can be made that the multiple will fall. Sorry, Jim, I think I'm getting some feedback there. If you could just mute your phone there.
Yep, just did it.
And so, kind of in that scenario, you put a 15 multiple on 190 earnings, you get under 3,000, still 20% down from here. I mean, this is what we think about from a scenario standpoint. It's not a prediction, but I think it's based on kind of prior history. I think it's something that we're open-minded to. And so when do we get constructive? It's really not until we see leading indicators bottom, stuff like PMI, ISM, jobless claims kind of top out. And really these things have only started to kind of break recently. And arguably they're only at the beginning, definitely not at the end. Next slide, please. So down the road, which could be a couple of quarters, what potentially leads a new bull market. So kind of typically when there is a new bull market that develops, there's a change of leadership. And we believe that there could be an emerging kind of new cycle, potential super cycle in commodities with just where the money has flowed away from that sector, both in terms of investments as well as true CapEx. And ultimately, when we come out on the other side, we think the new leaders will be cyclicals and commodities. And ultimately, some of the winners, whether it's growth or kind of long duration, may be relative underperformers. Next slide, please. So kind of within all that framework, this is how we're positioned today. We're quite defensive. We just want to get out on the other side, and capital preservation, we think, is still the number one priority. So our cash levels are quite high. Our net exposures are the lowest it's been since I've been managing. From a sector standpoint, kind of similar to what I just said, our biggest sector weighting is in stuff like energy. That's our favorite sector, although given the diceiness of the market, our relative weighting or our kind of absolute weighting there isn't huge. And on the other side, we're underweight, if not short, stuff like technology and consumer. So I'll leave it there for my part, and I'll pass it back to, I don't know, Jim, if you want to step back in and kind of get back to where you left off there.
Yeah, sure. I can just quickly go over it. Actually, go forward. Chung's covered a lot of the macro conclusions. So thanks for doing that. It's perfect. I should go forward more. We don't need to go over all of this stuff because it's pretty self-explanatory. So just keep going. Actually, go back one, please. Thanks. So maybe just touching on briefly the U.S. dollar. So one of the things that's coming out of the rate hikes, combined with the challenges in the rest of the world, geopolitical and otherwise, this strong dollar is effectively acting like a wrecking ball. You probably heard that term a bunch of times on global markets. Most trade is conducted in USD. And because of that, you have a couple of issues. You're getting issues within the EM developed market that trade in these, that trade and settle in US dollars. and you're getting challenges within the euro dollar market where there is effectively a shortage of dollars, which could also be expressed as a shortage of collateral. And these things are starting to have a significant impact on the rest of the world. I know the Australian finance minister, I believe, is going to be in Washington, and it's going to be a little conversation of the impact that that's having on their markets and elsewhere. But really, the Fed is pretty much committed to making sure that America is served first. But if there is a break, it's likely to happen outside of the U.S. Go to the next slide. And speaking of that, we've seen a couple of things already. So in the UK, we have this pension debacle, which is sort of highlights the financialization of the world to the extreme. This is a situation where you had pension consultants basically say, look, we can add a little bit more juice, if you will, to your product by doing these effectively these swaps, bumping up your yield, and just put it away, and you want to look at it. And but lo and behold, they do have to look at it, and they were getting margin calls, and now the Bank of England has had to step in and do their job to try and calm the market and alleviate different things. But that the challenge in the UK, like in Europe, is with the energy bills. We're looking at a sort of a near bankruptcy situation if consumers and businesses were forced to accept the current pricing regime. So they had to introduce subsidies and so on to try and reduce that stress, which in turn puts a lot of pressure on the government budget. And then we got the outcome from Truss and Kwarteng on the little mini budget they did, which was a resounding issue for everybody, and started triggering different things. So that's sort of a sample of kind of little bombs going off. The Japanese have a potential bomb that's been there forever. They're doing yield curve control and fixing the 10-year rate at 25 bips. And that's pretty tough when inflation is now starting to peek its head up in both Japan, and obviously you're seeing the inflation differentials and yield differentials now putting a lot of pressure on the yen. They had their first intervention in, I think, 30 years at 145. The yen is now 147. So what are they going to do now? I don't know, but clearly a lot of pressure there. And then in the US, we haven't talked about quantitative tightening that's coming down, 90 billion a month, plus a deficit in the US of $1 trillion a year. So back of the envelope, that's sort of 160, 170 billion a month that somebody's got to buy. And it's tough to do, and especially when you have the Japanese and the Chinese trying to defend their currencies and having to sell treasuries at the same time. So some of the natural buyers have kind of gone away. Anyways, I'm sure this will all work out, but it's undoubtedly adding a lot of policy stress in the world. And then we have these exogenous shocks, which include the Ukraine war, which seems to not be any nearer to a conclusion. We've got the zero tolerance COVID policy in China, which has held back demand. We've got obviously the US imposing effectively chip legislation and export legislation on semis into Taiwan. We've got the Chinese leadership now review starting shortly, and it looks like Xi will get another term, and it looks like his focus is going to be on security, not on growth, which means another kind of stool or another leg off the stool in terms of global growth happening. And obviously we've got the issue of Taiwan overhead. So lots of things to stress about, and lots of different things going on. As Chung said, the level of uncertainty is super high. And the key thing here is capital preservation and not taking the big drawdowns. And so far, so good. So we are looking forward to better times at some point, or easier times. But right now, it's clearly been one of the toughest markets. Chung and I were down to see Druckenmiller at a function a few weeks ago, and he said it was by far the hardest time he's ever seen in his career, which goes back farther than ours. And so I think if he thinks that, we're probably not too far off in agreeing with him. So we'll leave it there for the formal comments.
Okay, Colin, if you could run us ahead to the statistical summaries. I just want to run through those quickly. There you see for Canadian Advantage. In particular, I'm always quite taken by the up capture and the down capture, but also in this case, and in the case of all of our alt funds, the alpha numbers quite striking. This is what we're trying to do. This is what we come to work to accomplish. It's all about providing our investors with risk-adjusted returns, not just returns without any concern for the level of risk that has to be taken on to earn those returns. So there you see where we are to the end of September in the funds. October is down slightly. I can tell you to yesterday, Canadian Advantage year to date is now plus 2.66. Global Advantage is now negative 1.65, so up slightly. And Global Opportunities Alt is now 3.11 year to date, so down just over 1%. So still very solid numbers. Can you move ahead to the next slide, please, Colin? There's the Global Ops, a little shorter time period, but I just think it's really important for alt consideration that you look at what does the portfolio do to protect the downside when markets are challenged? And then secondarily to that, what does the portfolio do to participate positively when markets are constructive? Too often in the alt space, you find that you get only a 1 out of 2 deal, and you end up getting a bit of a boat anchor in your portfolio when markets are constructive. Now, from a 40,000 foot view, that might sound okay, but we all know that we have to manage client expectations. And if there's things in there that don't look like they're doing what they're supposed to do, they become problematic in the client-advisor relationship. So we really want to not contribute to that and be fairly contributing in up markets and really solidly protecting capital when markets are more challenged. Next slide, please. And then the Global Advantage Fund. This, as you can see, gives you a return per unit of risk that is substantially better than the MSCI. The gross or net number on the annualized return basis, although it looks somewhat smaller, you can see from the volatility we have to embrace to do that. And the up and down capture numbers, there's a substantially better outcome there for the volatility that you're embracing. So we feel like that's a very usable strategy for portfolios that are quite risk averse, that are more concerned about maintaining their capital and keeping it intact so that it can fund the various buckets, be it retirement, charities, community giving, children, what have you. And it's been a well-received strategy in the marketplace because it is somewhat unique in delivering that type of variable. So I think with that, what I'll do is open it up to questions. Well, actually, before I do that, I'd be remiss if I didn't go back and tell you what the key takeaways here. But I think you get the theme from what we're saying is that we're still not done. There's some work that needs to be done here in terms of capital markets and they're returning to a more constructive format. We have data points that we're looking for that we're not quite there yet. But if I step aside from that for a minute, this slide really highlights what we're trying to deliver across our liquid alternative platform. And we're trying to do it with alignment between us and your client. And we're trying to do it with what we would call responsible price points. And over time, we've been able to deliver a proven track record of results. As I said, both in up and down markets. And I can tell you, when you get a track record that's respectable like the ones that we have, you work very, very hard to defend those and continue to grow and build on those track records. And that really helps us to maintain focus and stay on point with respect to managing these portfolios in the alternative space. In terms of questions, I'm gonna steal the floor here and ask the first one, and it's for both of you. If you could just, Jim and Chung, come back to the Canadian alternative, Canadian Advantage alt, and just speak to how the two of you work together in terms of that portfolio and how it's allocated. Jim, you made reference to it at the onset that we have a bit of a transition from global advantage through to Canadian advantage to global opportunities. And that Canadian advantage space is one where you both have input and impact the portfolio allocation. So if I could just get you to spend a couple of minutes on that, that would be great.
Yeah, sure. Well, at this point, where we are in the cycle now, I think Chung kind of summed it up. It's a macro world, right? So, correlations have all kind of gone to one, if you will, and as a result, we kind of look almost identical at the world. I mean, typically Chung's coming at it from bottom up, knowing the securities, knowing the managements, all that kind of good stuff, and I'm coming at it from the data, forecasting and all that kind of stuff. And right now we're 50-50 in terms of capital, but neither of us are using our balance sheet. And depending on how this comes out, or how we look on the other side, it could be very much a move more capital into individual securities. I mean, I think that's coming. I mean, typically what you have in macro, the correlations go really high. And so the differentiation between companies goes away. And so in other words, the quality between, or the winners and losers kind of aspect kind of goes away. And if that is what ends up happening, Chung would get more capital, because I would argue that it'd be easier for him to make money in that kind of environment.
Chung, anything you wanted to add to that? I think from where I sit, I would guess that you probably have to have a little more attention to the macro variables in the context of your fundamental stock selection, whereas when it's a more, I guess, normal, if we can call it that, market, you'd be much more fundamentally focused. Would that be fair?
Yeah, that's exactly right. And I think it's been helpful for my process and kind of how I think about the market to have Jim and his views, because I think macro is difficult, and I think to have a framework and someone, kind of Jim has we have a team of people that also kind of help with the various funds, to have a team to collaborate with and talk about ideas and themes every morning. I think it's very helpful, and I think Jim, is very thoughtful in terms of managing risk and exposures and correlations. And the nice thing, at least from my perspective, is I can be reasonably kind of flexible in terms of my views, with paying attention to the correlations and kind of Jim's views. But it's been a good kind of, at least to this point for me, kind of combination of marriage of kind of the top down and bottom up focus, which I think we're open to shifting depending on market conditions. And I think so far it's been working well. And as Jim said, I think we're quite open-minded about shifting our allocations dependent on the risks and opportunities.
Great stuff. Okay. I do have basically the same question from two people here. So I'm going to throw this out to both of you as well. The context of the question is, we've seen a rollover in markets. We've seen your data points in terms of expectations of where we might go. The risk here in these questions is, do you miss an opportunity for significant upside just by virtue of waiting for the data to become more constructive, i.e. does the market start to move ahead of the data? And do you have concerns about that? And how would you approach that risk?
I mean, I can
go ahead,
jump in. I mean, sure. I mean, that's always the concern. At the end of the day, we have to stick with our views and stick with our process. Our views are based on kind of what our best guess is in terms of the sequencing of a market like this. The market is obviously always forward-looking, but we've highlighted reasons as to why we believe the worst has still not come. So I think the challenge is always, and today's a really good example based on the intraday price action relative to what most people would objectively say was a quote unquote negative data point, and we're up 2% or whatever we are intraday. I mean, bear market rallies are violent, and we've seen 3 or 4 already this year. I anticipate there's going to be many more. We saw, 2 days of it earlier this month. Ultimately, at least my view is those are bear market rallies that should be sold. But if there's new data, there's new information, we will pivot. But based on kind of our methodology, our view is that we still have yet to, it's still too early to be taking risks.
Jim, anything you want to add there?
Yeah, I would just add that when we're trying to do our forecasting, we're using leading variables. We're not using coincident or lagging indicators. So we're trying to get out in front of where growth and where inflation are going. Right now, I mean, we're constructive on inflation, like a lot of people are. It's just going to take longer. And that's frustrating for people that have had instant gratification from central bank heads for the last 20 years. That shouldn't happen. I mean, the risks of cutting or pivoting and allowing a potential wage price spiral to happen would not be great. I think the Fed knows that, and I think the Fed is serious about that. I guess the second thing would be we're in an exogenous sort of geopolitical backdrop that's quite a bit different. We haven't seen this since the Cold War in a serious way. There's been lots of little skirmishes with Iran and Iraq and what have you, but nothing really on the scale of what we're seeing now. And we're getting a lot of policy responses and that are almost come out of the blue, and they have big ramifications on growth and inflation. I mean, I would argue that potentially structural inflation is now, I mean, the idea of going back to 2 is a pipe dream. When I listen to people, it's all, 2, 2.5, and you can already hear the creep. It's probably going to be closer to 3. I mean, when you think of the next 10 years and all the onshoring, and if in fact this geopolitical thing plays out, we're going to have more inflation than we've typically had. So that just means, higher rates and a different kind of investment regime. And like Chung said in his opening remarks, next 10, 20 years are not going to look like the last 10, 20 years. And for people who are playing with yesterday's playbook, you might have a very bad outcome. And we're very open to the fact that, the world changes and things change, and we need to keep up with not only our models, not only with talking to managements and what they're doing, but also keeping in touch with policy. What is going on? I mean, if you don't have a view on China, or if you don't know what's going on in China right now, you're missing a pretty big chunk of global GDP and a pretty big set of information on which you can't really make investment decisions without. So yeah, we would love to pivot, but transitory is a term that was just booted out of the dictionary, and pivot might be the next term that gets booted out of the dictionary. We'll see.
Just in terms of your inputs, maybe I'll direct this to Jim. How often are you guys talking to, for example, the people at Hedgeye for their thoughts and input, or the people at Cornerstone, or any of the other services that we subscribe to? Is that a pretty regular communication line that's open there, or is it a little more ad hoc?
No, it's daily. Daily. So yeah, I mean, we do a lot of back testing, a lot of work internally ourselves. So we're always checking the models, verifying data sets and all that kind of stuff as well. And we're always, Chung and I listen to a lot of people, including some you might think are slightly crazy, but there's always little nuggets of wisdom around the market, and people that may know a lot more than you do. And about a certain area. And for us, I think we're pretty good at casting that wide and then filtering it down into an actionable investment strategy and policy. And that's what we just sort of continue to do. Our process has never written in stone, and nobody's process can be. It's always subject to improvement and modifications and everything else. And so, yeah, it's a daily exercise with all our counterparties.
And just to follow up on that, Jim, one of the comments we get pretty regularly in the field is, well, alts, I looked at them, they don't really do much. Maybe they're okay when the market's tough, but then they don't make any money in the good times. I'm kind of getting 50% of what I expected. Clearly in our experience here, we've been able to deliver on both participating in up markets and being good when markets are more challenged, as I mentioned earlier. Is there anything in particular that you would point at that puts us in that camp squarely, and that people can feel confident that we've got an ability to still compete on that basis in both up and down markets?
Yeah, so a couple of things on that. Firstly, as you alluded to in the last slide, the alignment of interest. So all my liquid net worth is in these products. So I care about it. Come to work to manage, my net worth, and Chung does the same, and others in the firm do the same. And so that'd be the first thing. And I would say the other real challenge is, and it's a challenge for advisors, is this is not a homogeneous market. And everybody who's running alt funds has a different sort of mousetrap. But I think the proof is in the consistency. And I've been in the sort of, call it the, for lack of a better word, the hedge fund industry since '95, and I've kind of seen everything in the sense of what can happen from fraud to phenomenal, and the challenge for advisors is trying to pick out the consistencies and the winners and staying on top of things. But so for example, in the US, the hedge fund, the fundamental long short guys, if you look at an average of these, it's been pretty terrible. And I would agree with the comment, I haven't really gotten what I paid for. And so there's lots of different functions. It's a function of size, skill, type of market you're in, and that. And so it's not easy. The only thing, or the key thing I think is to do a little bit of work, within your alt bucket, and figure out who are the people that are serious about it, experienced in it, and delivering, and sort of in that rank order.
Yeah, I would echo those comments and do so regularly. It does take a little bit of work for sure to figure out best fit. We also have to work with the firms and how they rate these products, the risk ratings, how they're categorized. There's a bunch of pieces that go into it. But I will say to both of you, it's really been a bang up job this year. So congratulations on that, and continued success in that regard. It's just before 1 o'clock. So in the interest of time, I think what I'll do here is wrap everything up. If you would like to get a copy of this deck, we can certainly provide it to you. A replay will also be coming shortly. If there's any parts that you want to re-listen to, or if there's questions that you weren't sure were answered, go through the replay and then get back to us if we still need to provide further clarification. But for now, I'd like to say thanks to Jim and Chung for your time. And thank you, everyone that logged in and listened in. We very much appreciate doing business with you, and we look forward to continuing to in the future. So with that, I'll say goodbye and enjoy the rest of the week. Thanks very much.